Gold still struggling as markets continue to digest last week's forecast-breaking jobs data. However, our next guest remains bullish on the metal and just released an 80-page report looking at what the real value of gold is in today's market. Greg Weldon of Weldon Financial joins us now. Greg, it's been a long time. Good to have you back on the show.
It's my pleasure, Daniela. Thanks for the invite.
So, of course, we're going to talk gold here. It's trading lower Monday, taking a cue from last week's weakness post-jobs data. So the question here for you, Greg, is does gold still have value in today's market?
Well, that's kind of our question that we pose to ourselves as we go out and kind of, put forth our view here. We have to backtrack a little bit to the end of last year when we first turned bullish after having been bearish for some time, thinking, hey, you had a 12-year bull market, you had a 4-year correction, the math was kind of perfect, the 3-to-1 ratio. Not only that, but the down move from 2011 was a very well-defined ABC pattern that matched the 50% Fibonacci retracement of that entire 12-year rally. So from that perspective, the math started to really fit in the fourth quarter of last year. That happened to coincide with the thought process that the Fed had threatened to raise rates many, many times. And if you look back a year and a half ago, the Fed would have raised rates 6 times already. As we know, they've only raised them once. And consistently since 18 months ago into the actual rate hike in December, they dubbed down their dot plot, meaning they flattened out the degree of rate hikes that they had priced into their forecasts. So there was a de facto tightening, which helped to hurt gold, and then it became a de facto easing, really without the Fed doing almost anything, just in the forward markets. And from that perspective, we started to think that gold and silver had a real good chance to put in a major bottom and kick off the next leg of really what's an ongoing secular bull move. So now, between then and now, we've had a big rally. So at this point, things have changed just a little bit.
So, Greg, let me ask you, despite the positive data we saw come out last week, especially Friday, you don't think we'll see a Fed rate hike this year?
I really don't. On the other hand, the data was positive enough to keep it in play, positive enough to keep the dollar kind of bid here. I mean, you lack wage inflation, even with the headline rise in the year-over-year rate of average hourly earnings, the innards, the weekly, the aggregate hours index, it's all still slowing sideways at best. So I don't think the Fed's going to go on a rate hiking rampage here at all. But in the meantime, like we said, from the beginning of the year, you've had some pretty strong moves in a lot of the gold and silver mining shares for sure, and in the prices of the underlying bullion as well. And you've had speculators pile in at record levels here. The Commitment of Traders report shows non-commercial accounts are as long gold and silver as they've ever been. So from that perspective, with that strength in the payroll number, we might expect to see a pullback that could be fairly significant in the near term, but we think that's a major buying opportunity for the longer term.
You've also said that the global economy has become a bonfire thanks to central bankers. What do you mean by that?
Well, if you look back to when we went off the gold standard and you look at the amount of credit that's out there, well, you kind of look at it like it's a bonfire. And to fuel the bonfire, you need to keep throwing paper, in this case currency, onto that bonfire. And this bonfire got to be in raging proportions in 2007 with the housing market. So, of course, they needed to throw exponentially more fuel onto that fire, i.e. central banks, which used to be considered monetary heresy to suggest central banks would monetize government bonds by printing dollars and expanding their balance sheets by trillions of dollars. And we said that in 2006. I mean, it was considered real monetary heresy. And of course, that's exactly what happened. They had to put exponentially more fuel on the fire to keep kind of the global economy, reflated to whatever degree they could. You let that fire burn out, you have a debt deflation, and that's the last thing they want. So from that perspective, what's the next step? What's the next thing that central banks are likely going to be forced to do? Isn't helicopter money seemingly as crazy now as it was to think in 2006 that the Fed's balance sheet would be $4.5 trillion?
So Greg, let me ask you, a lot of people I speak to that are bullish on gold often give me the same reasons you just cited now. But my question is, when can we see these factors start boosting gold prices? What would be the catalyst?
Well, you've seen it. And I mean, the catalyst is a increasingly, seemingly desperate position on the behalf of central banks to try and create reflation. I mean, look at what's going on in Japan. I mean, another case in point, even closer to home, Daniela, would be Canada. I mean, the Bank of Canada has been aggressively buying assets. Their balance sheet is at the highest level ever, and you have the highest 6-week growth since 2008. So you have a lot of central banks where rates are cut to the bone. I mean, we don't have to discuss the $11 trillion of sovereign debt that's yielding negative yields. I mean, right there is a catalyst. It makes gold at a, I mean, the thing that people, when they shun gold, they say, well, it doesn't yield anything. Well, in this case, it yields a heck of a lot more than, a lot of sovereign bonds out there. So I think from that perspective, you have reached a tipping point in the bond market, which, creates a case for gold going forward, particularly not when, but if you get this next kind of more desperate push like you're seeing in Japan. Something's got to give in Japan. What they just facilitated with their fiscal package, not enough. Central banks got to back that up with something. Permabond, something more is coming. And I think gold markets are sniffing that out in a bigger picture way.
Okay, Greg, the few seconds we have left, just your gold forecast. So where could you see gold headed this year?
Well, I mean, over the course of the year, we kind of were looking for 1,400 overall. I think from here, a pullback somewhere into the 12 to 1250 range. We have very specific targets, in our recent report that we've done in terms of how we see this playing out. But I think in the longer term, I mean, you look at a place like Canada, you're only 100 Canadian dollars from the all-time high. A lot of this has to do with what currency you're buying gold in. So from that perspective, I think, longer term, it's fifth wave of a multi-decade bull market that has new highs in it.
Greg, thanks so much for your thoughts today.
My pleasure.
Thanks for being with us. And thank you for watching. We'll see you tomorrow on Kitco's Gold Report.